Welcome to Fixated, the Fixed Income Podcast. I'm your host, Elizabeth Moran, Editorial Director of Fixed Income News Australia. Join me as I talk about the latest news, views and education in fixed income investment. I'll be joined by industry experts from Australia and across the globe. Welcome. Today I'm very excited to have Adam Marden, Co-Portfolio Manager for the Dynamic Global Bond Strategy at Rowe Price, join me for this podcast. Roughly 75% of the fund is invested in government bonds, so Adam is continually assessing global economies and central bank strategies. He's in Australia to meet clients this week, so we were lucky to catch him. Welcome, Adam.
All right, thank you, Elizabeth.
So inflation and whether it's here to stay has investors wondering how to invest. Can you please talk about T. Rowe Price's outlook?
Sure, Elizabeth. So if we take a step back, think 40 years ago, we started on this big disinflationary dividend, starting with first energy productivity bottomed in the late 70s. And then we were able to just get oil at a cheaper rate for the next 40 something years with little swiggles in between. Then EM capital accounts also started opening up, which is what we call, globalization. Then in 1991, the Berlin Wall fell. So Western Europe had this new supply of cheaper labor to be able to send their supply chains to. And then in 1997, you had China join the WTO. All of these led to this big global disinflationary globalization dividend that we all have grown up on within our careers that all kind of peaked right around the mid 2010s. And since then, we've started seeing it reverse. Energy productivity is a little bit lower. We have this deglobalization push. A lot of different regions you have to reorient their economies and for different reasons. For example, Western Europe, their economic model was importing stable energy from Russia, setting up their supply chains in Eastern Europe for cheaper labor, exporting high value items to China. All three of those broke down in 2022. And now you have a bunch of companies and countries rebuilding and reinvesting to set up new capital stocks. So to directly to your question, we do think inflation is going to stay higher than central banks would want them to for a longer period of time uh, because of these cost push issues we talk about. But also, if you look at a little bit shorter term, we believe the demand side is starting to come through as well. You're seeing a broadening out of just from the quote unquote AI trade. And I put it quote unquote because people talk about the narrowness of AI. But if you look at the AI CapEx cycle, it's bigger on a global percentage of GDP than the Chinese commodity super cycle was, which Australians know so well. So all of these are big numbers, and this is a big deal in terms of what we're seeing. We're seeing demand pick up as well after we went through a 3.5 year downturn in the manufacturing cycle. So all of these factors lead to inflation staying stickier and more stubborn than central bankers globally would want it to be.
So do you think central banks are being too soft on rates, and could we see inflation becoming entrenched in markets, do you think?
Well, too soft is a little bit tough on central bankers because central banking is a tough job. I would say I know Governor Waller would disagree with this on the Fed because he said just last week that the fact that central bankers don't affect the cost of capital for the hyperscalers is nonsense. The truth is, it's not affecting their spending. I do believe the central banking transmission mechanism is weaker today in a lot of countries than it was, say, 20, 30 years ago, specifically in the US, where they had a lot of structural changes within the economy, not least of which switching all mortgages from floating rate to fixed, which completely slows down a lot of the demand side factors in terms of monetary policy transmission. Now, it does affect housing quickly in terms of a lot of the changes in affordability of getting newer homes, but it's just a lower transmission mechanism. I would say that if you think about them being too soft, I don't think that's fair to say just because they need more data. And we have been in this disinflationary impulse since 2022 over the short term. We do see that starting to pick back up. And a lot of this wasn't just because of Iran. If you look last year, the factory of the world, China, effectively said we're going to stop selling things at a loss, which they've been doing for the past 3.5 years because Chinese PPI was negative. And if you look at Chinese industrial profits and PPI, it's effectively a very correlated number. That changed at the end of last year. Then also, if you look at US retailers, they ran out of a lot of the inventory that they had front ran before Liberation Day. and they started having to raise prices near the end of last year. So all of these inflationary impulses were starting to build, not the least of which labor bottomed right around October of last year as well in the US. So all of these impulses are picking back up, on top of the which you see the oil pass through in places like Europe, and especially places that don't have refineries or their own energy sources. So whether they're being too soft is a little bit tough to say, but I do think if it stays stubborn for longer and they don't react, then you could say they're being too soft.
Fair enough. Fair enough. I understand that you're concerned about the inflation growth trade off in Australia. Could you perhaps please discuss the implications for the RBA?
Yeah, so the there are two parts of the energy side. One is just the outright crude, and two is the downstream product. The outright crude, we weren't that worried about during the Iranian conflict, just because it was kind of clear that we could get crude from a lot of different places, and that probably more crude was getting out of the strait than the data was saying. Now, the downstream product issues are a bigger deal. Diesel's the bigger issue in Australia, jet fuel more so in the UK, things like that. So the implications for the RBA are tough. Again, like, as I said, being a central banker is a hard job. I would say with Australia, what they do have a little bit of the luxury of is they've already hiked back rates. The issue is that inflation, while some people say it may be peaking, you still have to wait to see the like whites of inflation's eyes peaking. And also credit growth from the commercial banking sector is still accelerating at about an eight handle. So underneath this, you do see some signs that the Australian economy could be softening up, specifically in some parts of the housing sector. But I would say again, they've given themselves some time by rehiking rates over the past year. But again, they're going to have to wait to see kind of the implications for themselves in terms of if they do have more downstream product issues on growth, because eventually the growth downside will lead into inflation in Australia, as we've seen. Australia, the good news for the RBA, well, that was the bad news. The good news for the RBA is their monetary transmission mechanism has not been weakened in the past 20 years as it has been in other places.
So, what are the implications for domestic bond yields and credit markets and actually investor positioning, do you think?
So, in a lot of curves globally, we don't really like duration. Australia is one of the exceptions because of, like I talked about, the monetary transmission that the RBA has. You started to see some banking activity, even though commercial loan growth has been accelerating year over year. You're starting to see some weakness and some pullback across different areas. Now, I will say we still have to wait to see the full data flow through, but we've started to see it kind of point out in certain areas, especially in some sentiment areas. So we do actually like Australia, and we do believe the duration is attractive in Australia. The Now other types of opportunities within the country, within the currency, et cetera, that's a more of a global question in terms of what your pair is. But outright, when we're looking at global rates and the relative value, Australia is one of the few that flags very attractive to us.
Oh, fantastic. Um, so, you actually see our domestic market relatively attractive to the rest of the world. Does that mean you're allocating more funds to Australian bonds and securities?
Yes, on the rate side, we are long duration in Australia for some of the product issues and growth issues that we talked about, but also just the reaction from the RBA quickly. And you've also seen a change in sentiment within the consumer within Australia as well. So we see that, and mostly that's on a relative basis as well. So some of the, like I said, like the data is still accelerating on a year over year basis across most indicators that you see, but you're starting to see some signs of weakness here and there. And the difference between that and most other curves we see is just you're not seeing signs of weakness in a lot of other places globally. So on a relative basis, if we were looking at, say, if you were looking at Australia in a vacuum and I didn't have any other country to look at, you might be a little bit worried about rates. But when you think of it on a global relative value basis, it looks a lot more attractive.
Okay. You were talking about the hyperscalers and AI earlier, and I need to ask you this: how do you feel about the rates they're issuing new bonds at? And is there value for money there? Are they too expensive? What's your thoughts on that?
It depends on the hyperscaler you're talking about. There is. I can't say specific names, but one of the hyperscalers or early issuers that started issuing last year is now sitting on top of Nigeria in terms of their lending rates. That looks a little bit attractive on a relative value basis. That said, I do think it's important to keep in mind that the Mag 7 slash hyperscalers were financing free cash flow negative, i.e., buying back stock for the past 15 plus years. And now they've just had 1 year of positive financially free cash flow, raising capital, and people are freaking out. It's going to be more. They're going to spend more. They're going to spend as much as the markets allow them to. The issue is with that is not necessarily if there's capacity in the fixed income markets to take it. The fixed income markets always end up taking down the debt. It's just a price issue. The bigger issue isn't just the hyperscalers issuing, it's that we've gone from this global savings glut to now global competition for capital. And it's not just the hyperscalers, it's every government is running higher fiscal deficits at this point in time because of the reorientation of the economies we talked about earlier, because of a lot of the different setup of non-discretionary items in their budgets that now are very, very difficult to get out from a political standpoint. And that's going to continue for at least the medium term time horizon that we see. It takes until we get to some breaking point before you see fiscal austerity, and we're just not there yet. But directly to your question, uh, are those deals widening out? Yes. Are they going to keep widening out? Yes. And do the hyperscalers care at this point? No.
Finally, I'd just like to talk a little bit about the dynamic global bond strategy. As at the end of 30th of June 2026, the fund had an average single A credit rating and a nearly 6% yield to maturity, which I think is excellent relative value. But looking at historical returns, I saw that over the last 3 months, the fund returned close to 5.5% net, which is excellent. Could you explain what happened, please?
Um, well, again, let's take a kind of zoom out a little bit. Part of the reason is March wasn't great for us. I'll walk through it a little bit too with March. When the Iranian conflict started, and as a background for the dynamic global bond strategy, we aim to do a cash plus strategy. So we have a cash benchmark. We try to get 300 basis points above cash over a long period of time, depending on the specific vehicle. But the key with it is to harvest convexity in time. So we tend to look if you when you go through a volatility cycle, when i.e. a spike up and down in the VIX or a spike up and down in the move, we tend to make a lot of our money in that cycle. Sometimes at the beginning, sometimes near the end. But the key is through a fall spike and cycle, you should see us a step function up in performance for us. That's what we tend to promise clients over time. Now, if we could predict every single volatility event, that would be amazing. The problem is we can't. We did not expect Trump to invade Iran. So what you have to do when you have these volatility events. Yeah, we have a certain amount of downside set up for this. And we have a certain amount of portfolio construction structured for any sort of scenario in one way or the other. The issue was about a week and a half into Iran, we were effectively flat, but our biggest advantage is that we have the platform at Rowe Price. We have all these equity and fixed income analysts that know these companies, which are we believe are the economic drivers of the world. And then we talk to them and try to figure out what's really happening. And so when you have a volatility event, the key isn't to necessarily to predict every single one of them. The key is to diagnose them when they happen. And we have our 4P process. One is profits. If you look at earnings revisions during Iran, earnings were actually accelerating. A lot of it was from semiconductors and energy, but still, discretionary earnings weren't getting marked down because you already had a low base. Second was the principal component. What was driving the vol spike? And in this case, volatility was driven by oil. And then three was the platform, and our platform told us that a lot more oil was probably getting out than the headlines were saying. Again, we don't know how, but like it was getting into the curves, and inventories were running down, but not as bad as you would expect for a lot of reasons, from Chinese SPRs to the US SPR, et cetera. But it's enough that we could track this. And then four was positioning, which is where we kind of got it wrong a little bit, in the sense that we positioned portfolios probably a week or so too early. I'm a big believer in this industry. I hate when a lot of my colleagues say we weren't wrong, we were early. You can be wrong and early. And that's where we were for a couple weeks. So we ended up buying a lot of value in curves that we saw that were just pricing in too much in the UK, Australia, New Zealand, et cetera, that were going to have these product issues that we talked about if this persisted for a while. What we got wrong was the positioning. We thought after about a 100 basis point sell off in the front end of the UK that position was clean. We had more in there to go, so we lost a little bit. We lost a decent amount in the last couple weeks of March, but then we made it all back plus some in the next month or so. So a lot of that. So directly to your question, how did we make 5+% in the past quarter? Most of it was rates in terms of our long duration positioning that we held through the first half to end of April. Then we ended up shorting duration again into May just because we knew that the nominal growth environment was actually going to start taking hold again, that we talked about with the broadening. We traded a little bit better in terms of going longer later, but we've been shortening up our long here. And then all of the credit and longer convexity positions that we added in March, we've whittled down quite a bit since then. So as with our mandate, about 60 to 70% of that was rates, 30 percent of that was credit and FX and other convexity products.
That just goes to show the benefit of having an active global manager managing your funds, right?
Yeah.
I'm thinking,
Yeah.
long duration, short duration, changing the mix constantly, which is really insightful, and thank you for that. Wrapping up now, is there anything you'd like to say to our listeners?
The only thing I would say is that I would, oh, I do think these regime changes tend to be a little bit worrying to a lot of investors. I do think with fixed income, it's a great time to buy fixed income, but not from capital appreciation from carry. It's for you can make like 5, 6, 7% yields on quote unquote safe products. By when I say quote unquote, you have to manage your exposure quite a bit over time. I just think when we're going into this higher nominal growth environment than we've experienced for the 20 years before that, there are important details about this. One is you have to be active with it because this is and the, part of the reason inflation will stay higher to your earlier question is when we talked about the hyperscalers going from 15 years of negative free cash flow to a year of positive free cash flow. What that negative free cash flow buying back stock was a shift from the real economy to the financial economy. Now reversing that and then raising capital is a shift back from the financial economy to the real economy, which is part of the reason inflation will stay higher, nominal growth will stay higher, and more than likely, if this nominal growth paradigm continues, which we believe it will, then that second question you asked me, will are central bankers being too tough on inflation? The real answer is we'll see, because I do think inflation is going to stay stubbornly high, but that actually leads to a great opportunity for you to invest in fixed income over a long period of time as an active management across all asset classes. But the key is with active. But even though I do believe the value will be shifting back from the financial economy from the past 30 to 40 years back to the real economy, that does lead to much more opportunity for active management within the financial economy.
Adam Marden from Rowe Price, thank you very much for joining us today.
All right. Thank you, Elizabeth.
Thank you for joining us this week on Fixated, the Fixed Income Podcast. Still hungry for more fixed income news, views and education? Then visit fixedincomenews.com.au and don't forget to subscribe to our newsletter to have the latest news delivered right to your inbox. Thanks again for joining us. I'm Elizabeth Moran and we'll see you next episode on Fixated, the Fixed Income Podcast.